What's the biggest risk for oil traders when Iran sanctions begin?
Well, let's ask our next guest that, because he sees oil prices moving higher into the year end and recommends buying WTI and selling Brent. Mark Keenan is a global commodities strategist at Societe Generale. Mark, thanks for joining us. Well, the answer to that question, first of all.
Well, I think we'll see on Monday. I think that, the market has been very concerned about the imposition of Iranian sanctions as far back as July and August when they were announced. And price action over the months of August and September, taking us up to the mid-80s in Brent, was largely predicated on compliance to the sanctions being very strong, Trump being very steadfast in that, and concerns about OPEC's ability to make up shortfall because of it, and hence concerns about OPEC spare capacity as we moved into the rest of the year. Just yesterday, we've had a little bit of a wobble on that. We've had some commentary from the NSA advisor to Donald Trump, John Bolton, saying that he would entertain the idea of short-term waivers, I think on countries like South Korea, Turkey, and India to a degree. There's no clarity on that yet. That may be something just to move oil prices down ahead of the midterms next week. We'll have to see. But certainly it's on the radar screen. We expect about 1.7 million barrels of production to be lost because of the Iranian sanctions, and the weakness in oil prices that we have now, which was largely a function of the risk-off environment we've had in the month of August, taking us down to around $73, we see as a buying opportunity, looking for oil to move up to around $82 in Brent in Q4 of this year.
But you're saying sell Brent, buy WTI. Why has the spread between the two widened as much as it has? And I suppose what you're saying is that it tightens.
Well, there's two ways of this. There's two separate trade ideas here. There's a directional view, which we can play out with Brent, and there's a relative view which we can play out between WTI and Brent. So the arbitrage, as it's referred to, has widened significantly with WTI at a heavy discount to Brent, approaching just recently almost $11 a barrel. And that weakness in TI has been driven by inventories in the U.S. ballooning, specifically in areas like the Permian Basin, where we've suffered from issues like pipeline bottlenecks and the inability to get all of this shale oil out that's at record production in the U.S. out into the international markets. As these pipelines start to be built, and we expect them to be completed in the second half of 2019, that discount of WTI to Brent tightens up, and we expect it to move from where it is now, around $9, $10, up towards $5 a barrel. So playing the arbitrage is a separate trade idea, trade recommendation to the directional view that we expect on Brent into year-end from the levels where we are now.
Yeah, and I think what led to this drop also, Mark, was OPEC coming in talking about how they've increased output by some 430,000 barrels a day in October, and they've really kind of shifted to this kind of produce as much as you can mode. Do you think that can continue through 2019? Is there still enough spare capacity here to offset the losses from when these sanctions kicked in on Iran?
Well, that's the key thing, and that is one of the sort of drivers of our bullish view on oil prices here, because not only Saudi Arabia but also Russia and the US are all producing at record levels, and we're at $73 a barrel. So as we start moving past next week and into the rest of the year, and we start to see the actual effects of the Iranian sanctions on the supply-demand balances, focus will then shift towards spare capacity. And there's very little spare capacity. And spare capacity is one of the most powerful and explosive drivers of prices. And if we combine that potentially with a cold winter, with ongoing stable demand, then we expect prices to move higher.